Good afternoon, everyone. It is May 13th of 2024. This is Robert Rayburn here at Life Pro Asset Management. And what we're going to do this week is really focus on the ongoing corrective or consolidation phase that we're seeing in the stock market. We also want to look a little bit at what's happening across the globe as it relates to interest rates and stocks and how that impacts how we think of asset allocation here in the US, where we're seeing those opportunities, and more specifically, where we're seeing some of those heightened risks in the overall market. So I'm going to go ahead and share my screen like I do every single week. And what we're titling this week's presentation is it time to invest outside the US? And not the most creative title by any stretch of the imagination, but kind of gets to the point where the US has definitely been leadership for many, many years. And right now, where we're seeing a lot of the bargains as it relates to private businesses is really outside of the US. And we're starting to see subtle shifts that, hey, you know what? Investors are starting to realize that, yes, US companies are definitely some of the best in the world, if not the best, but they're very expensive. Meanwhile, you have some really attractive merchandise overseas that's heavily discounted, especially relative to the US. So three big things this week: bear and bull case for the stock market. We definitely want to go through that. Number two, what we think is working and not working when we look under the hood of the overall market. And then a real quick global bond market snapshot. It's not something we've done in a while, so I want to dedicate a slide to that because it impacts rates here in the US and definitely impacts how we think of income investing and as well as risk allocations. So this chart here on the right, I do want to point this out real quick. Why do we pay so much attention to whether a stock market is in a positive, negative, or neutral trend? This chart says it all. When we look at seasonality from really the third week of May through July, what we can see here is the phrase of sell in May and go away is quite frankly is very misleading, if not downright fraudulent when we think of that phrase. Because you don't really have that seasonal weakness from May through July. Where you do get seasonal weakness is more in September, back half of August, and then the first couple of weeks of October. That's really where you see some distinctive weakness as it relates to seasonality, but you don't see that in May. And when we look at the green line here, what this green line shows us is that when the stock market's in an uptrend, that May, June, July time period tends to be pretty good. Even all observations look pretty good. It's really when the market's in a sustained downtrend, which it's not right now, is where you see some challenging times. Quite frankly, I would be remiss to guess that if the stock market was in a downtrend, no matter what time period you are in the year, you're probably facing some challenging forward returns. So overall, in terms of stock market, we've had a nice, strong bounce, good momentum, right? That momentum has been strong. Breadth has been expanding. 56.25 is an important level. That is the prior high of the market before this corrective process began. 49.54 is that low of the correction. So overall, the market corrected about 5 or 6%. Is it over? I don't know, right? And that's I think that's the most honest answer that most people can give. What we can do is say, what are the symptoms? The symptoms are pretty good on this bounce. That's in addition to that, you're seeing protection being sold, right? What that means is sort of when you think of life insurance, if you thought you were really, 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 really healthy with no kids, no wife, no spouse, what would you do? You probably wouldn't buy life insurance. You feel really confident about yourself. Same goes to the stock market. When you are nervous, you buy protection against portfolio losses. When you're not nervous, you tend to defer that payment. That's what we're seeing right now in the market. That, of course, does not mean the market can't go down. But overall, we think that the symptoms remain fairly benign. In other words, we would select our spots in the market to go shopping. So what are the portfolio moves that we're doing? We're decreasing our energy exposure. We're going to go through why in this presentation. But real quick, we see some cracks forming in the consumer. We think U.S. growth is not recessionary, but it is slowing. What are we doing as a result of that? What are we doing with that cash? We're increasing our exposure outside the U.S. So China and emerging markets are those areas that we're really focused on. And then lastly, on the income side, we are looking to lock in some of these higher yields across our income portfolios. Why is that? Well, when we look at interest rates in Europe and in Asia, they've really started to peak out and come down. Rates in the US are off their peak. We do see signs that US economic growth is slowing. So if that is the case, you could see rates across the world start to drop, and we definitely want to go ahead and lock in those rates. VIX, we talked a little bit about volatility. So that portfolio protection, that premium that you're paying for portfolio protection continues to drop. So the fact that VIX is below 13 tells us that we're kind of in a structurally benign market. When I mean benign, I mean there's nothing out there that is looking to swat the market upside the head in the next day or two, right? Now, of course, as we send this out, watch there be something. But when you see the VIX drop below 13 like that, it is really a symptom or reflection of a healthy market more than anything else. You can see here, as we got out of COVID and into 2022, you had a market, even when the VIX was at the low end of the range was 18. Prior to COVID, and I didn't extend the chart further back enough, but prior to COVID, you had this market where VIX at the low end of the range was 12 or 13, at the high end of the range, 18. Very similar setup right now. And I think that's actually a positive symptom. That doesn't mean, though, that you can just go and invest anywhere, right? There's two things we want to do. We want to understand where we want to deploy that capital, what areas of the market we want to avoid. We think it's a stock picker's market. And secondly, what is the bear case, right? Like there's always a bear case. We're long the market. So that means if we're long the market, our risk is that the market goes down. So what could potentially make that market go down? These are the Vegas odds of a recession as provided by FS Insight. So we see right now is when we look at the betting odds in Vegas, right now the market's pricing about an 8% chance of a recession. Now, a lot of people, including FS Insight, have circulated this chart as a positive thing. As someone who's bullish on the market and bullish on the areas that we're invested in right now, I don't like to see this. Why? Well, when recession risk was perceived to be really high last year, we look back here to the left in July of 2023, that was a great time to buy the market. That was actually the time you wanted to deploy capital. When no one thinks there's a recession, that tells me that no one's positioned for a downturn. Everyone's positioned super long on risk. So that could be a contrarian way to think about how the market could go down, right? Because the recession risk is perceived to be so low, any hint of recession risk or slowing can potentially lead to the market coming down as people reposition their portfolios for slightly higher risk. So that is something we do want to pay attention to. So when we think of the last time the S&P 500 was at 5,200, economic growth was strong. Investors expected, I would say, more than 3 to 4 rate cuts, probably 5 to 7 rate cuts this year. And inflation was falling pretty fast toward that 2% target. This time around at 5,200, a lot of these economic metrics that we look at are definitely losing some momentum. They're slowing. That's actually, I think, a good thing. We'll get to why that is in a bit. Investors are just expecting 1 or 2 rate cuts now, and inflation is no longer falling and is actually showing signs of bouncing back. What I wanted to do with this slide is not say this is our view, but to keep ourselves honest and say, this is what could go wrong, and this is what could cause that to go wrong. Markets are all about positioning. Markets are all about price. And so when positioning is too aggressive to one side, the risk is that one thing causes that positioning to reprice. And that's really what I think is the risk right now. We're prepared for that in terms of how we position the portfolios. So what are our thoughts? We think the market symptoms generally remain positive, right? So yes, technology and consumer look weak, but industrials look really strong. Energy looks okay. That's faded a little bit, but industrials look really, really strong, and so do the banks. And so does copper, and so do emerging markets in China. So it's really hard in a global recessionary environment for those things to really be giving off positive vibes. Second, economy is slowing, but does not appear to be recessionary. Remember, slowing's good, gives the Fed the green light to potentially cut rates. So now everyone is priced in that there's going to be no rate cuts. So now, if you are looking to position a possible trade, you may want to look at, say, hey, what would do well if we did cut rates? Because position is so aggressive to now no rate cuts. Now I'm starting to think, well, maybe we should look at the scenario of a rate cut, right? So again, it's all about positioning. Third, industrial banks, emerging markets are accelerating. That is not a recessionary symptom. Credit markets are well behaved. Again, not a pre-recessionary condition or recessionary condition. The primary risk in our mind is a market rotation out of the popular spots, such as tech and consumer, and into some of the less popular areas, quite frankly, the areas that we're in. So how is consensus position? We can see here, technology equal weight index in the S&P, again, off its highs, fading relative strength relative to the S&P, and we see the same thing with the consumer, right? So the consumer continues to fade from a relative strength standpoint, off its high, and even on those bounces, not reacting as positively as the overall market. Again, yellow signals across the board for that. And I thought Steve Druckenmiller, who's one of the greatest investors of our era, I thought he said it best about NVIDIA. Yes, they are long-term bullish on AI. He was a big holder in NVIDIA and has started to trim back his position. Why? Well, he said that the NASDAQ in 1999 correctly predicted that the internet was the next big thing. But that didn't mean it couldn't go down 80% between 2000 and 2001. Price matters, right? And so what he's looking at right now is that everyone is overhyped on AI. And while he doesn't think it's going to go down 80%, a lot of these names could go down sizably, right? So whether that's 30, 40, 50, 60%, he doesn't know, but he thinks it'll be fairly dramatic. And so he's taking some gains and investing in other areas of the market that are cheaper. And I think that's a logical way to look at things, right? Is that yes, AI we think is the next big thing, but we don't have any exposure right now. Why? Because it's really expensive, really frothy, and really crowded. Let's wait for those crowds to leave the room, then we'll go and pick our spots. So where could the puck be going? Emerging markets. We talked about China in prior weeks. This week we're looking at the EM. China's a big component of the EM. Again, breaking out of this multi-year consolidation from a relative strength relative to the US, again, breaking out, right? So we think of EM relative to the developed world, really looks attractive. We see the same thing with the banks. Whether you're looking at specific banks like Bank of America, JP Morgan, the regional banks, all these banks are acting quite positively. And a lot of people are still fairly negative. They bring up consumer credit balances. Are people keeping up with their credit cards, buy now, pay later issues? That said, the stock market is saying that something else is happening here, right? And I don't have the industrials chart, but the industrials chart looks very similar as well. Strong leadership, 52-week highs, outperforming relative to the S&P 500. These are cyclical areas of the market. Copper, unabated new highs, 52-week highs. That just doesn't happen ahead of recessions. One area that we do see signs where things are slowing is obviously in the interest rate side. So whether we look at the UK, Germany, Italy, Sweden, all across Europe, we're seeing interest rates start to fall. And so when rates are moving lower overseas, global bond markets, including US treasuries, are all priced relative to each other. So we do think that'll act as gravity for US rates, combined with the fact that US is showing signs of economic slowing. What does that mean? Consensus right now is positioned for higher rates. We've been the biggest cheerleader of higher rates. We're now starting to reposition for lower rates. Is that a precursor to a US move? We think so. And that's why we're locking in some higher rates on the income side and then looking at the portfolio on the equity side and saying what can do well during higher rates and what would do better during lower rates. Let's position for that lower rate scenario. Credit markets, we go through this every week, but again, when lower is good, that implies less credit risk. So again, that continues to drop. No signs of no yellow or red flags out of the credit markets. So we don't spend a lot of time here because it looks pretty good and there's no signs really that that's changing. So summary, there is a potential rotation at hand, something we want to pay attention to. The stock market bounce does look strong, but more work is needed. We want to take this day by day, not just deploy all our capital all at once. We do believe that tech and consumer continues to weaken. And we see that in the price action. As a result, we've increased our bank exposure over on our blue chip side. In the growth portfolios, we continue to accelerate our exposure to emerging markets. We love the area. We think it's very, very contrarian. We have decreased our energy exposure. That's another thing I didn't mention, but we did decrease our energy exposure. We are starting to see supply pickup on the energy side. We've had some very strong gains in that sector. So just taking some profits. We've generally speaking as a portfolio reduced the sector weight from about 30% to 20%, reallocated that toward emerging markets. And then lastly, we do think interest rates may be peaking. So that's what we got for you this week, 888-543-3776. Thank you again for your business, your time. And if you have any questions whatsoever, please feel free to give us a call, give your advisor a call. We're here to help. Thank you again.